Hey, finance folk! Welcome to the EU Finance Podcast. My name is Aidas Palubinskas, and I am your host. Warning. Anyone younger than me should not be skipping this episode. The younger you are, the more you need to know about this. You know that thing you keep meaning to sort out but never quite get around to? The thing in a folder somewhere labeled important, your future depends on it. Yeah, that one. Retirement savings. If you're young, you might not have seen or noticed that folder yet, but it's there. It might be hidden, but it's a system folder for sure. Well, the EU has been thinking about it for you. Because here at DG FISMA, what I like to call the EU's Ministry of Finance, we've been watching the numbers, and the numbers are not entirely comforting. Europe is aging. Many of us should expect that our pensions are going to be less generous than we expect. So what's the answer? Supplementary pensions. The pension on top of the pension. Last November, the European Commission launched a package to make supplementary pensions better and more accessible across the EU, revamping the rules for occupational pension funds, relaunching the pan-European personal pension product, and recommending that member states get serious about auto-enrolment and pension dashboards. What? I think we'll need an expert to unpack all of that. So today I'm joined by Tilman Lueder, the head of unit for pensions and insurance here at the Commission, who knows considerably more about all of this than I do. Let's talk pensions while we're still young-ish. Tilman, welcome to the podcast.
Thanks for having me.
Let's start at the beginning, because I think a lot of people, when they hear the words supplementary pensions package, their eyes might glaze over a little bit. So, in plain language, what is the Commission actually proposing here?
What we're trying to achieve is that people do private provisioning, private savings for their retirement. There is a state pension you get, it's linked to your final salary. That's good, but for a lot of people, that will not be enough. So what we're trying to do is that people take additional savings, they subscribe to additional products where they build up a pension pot so that they can retire at a decent level with a good retirement income, and they need to take out either an occupational pension or they need to take out a private pension. And these are the two alternatives we're trying to develop further.
Okay. Sounds reasonable, but why now? And why do we need this? I mean, pensions aren't a new invention. What was broken or missing? What made the Commission say right now, okay, we need to do this?
I think that's a very good question. Right now is actually too late. We should have done this 20 years ago. We should have done this probably, if you're really honest, we should have done this after the Second World War, because that's how the Netherlands did it. They built up, because they knew the state was ultimately not going to be able to finance your pension. They built up a supplementary pension, which is an occupational pension scheme. They have huge funds which invest all over the world, and they produce a very, very good return for the pensioners. So we are late. So why now is actually no longer the question. We're much too late. We're trying to now replicate the success of the Netherlands with all kinds of means, which we can discuss further. But the essence is, this is a long-haul effort. This is something which we should have started 40 years ago, now trying to catch up with well-developed supplementary pensions. It's a bad word. It's actually just additional pensions on top of your pay-as-you-go. Canada did it after the Second World War. The Netherlands did it. Sweden and Denmark started to do it in the 60s. And now finally the European Union has woken up and says, okay, everybody in Europe actually has to do this.
Okay, well, that makes sense. I mean, the European Union wasn't around after World War II, so we can cut it some slack there. Now, this is something I really want to nail down, because I think it's easy for this to feel quite abstract. So let's make it more concrete. Who actually benefits from this, and what does it look like in practice? Are we talking about this being for somebody who's just starting out in their career, somebody midway through, or somebody close to retirement?
We're talking about all three. The optimum, of course, is that you start when you're very young. So you have your first job, either your employer sponsors a pension product, or the employer offers an occupational scheme, which is funded. What we want is not that the employer just has a promise to you, once you retire, I'll pay you X% of your salary. We want actually these schemes to be funded. So they have to be invested in capital markets. You can see how the return accumulates over the years as you go. So the optimum is you start very young, you have a product, either a private pension where the employer contributes or an employer-sponsored pension, and you can see that capital accumulating. If you missed in your 40s, your 50s, you can still start. You may have a slightly different investment portfolio, which is a bit more liquid, but you can still start. But even if you're 55 and 60, it is not too late. You can still start accumulating because you still have 10 years to go. And if you are in the capital markets, 10 years is a decent period where you can still accumulate a decent pot.
Got it. One of the really interesting things I find in this package is the concept or the push for auto-enrollment. How does that actually work? Does the employer just sign you up whether you like it or not? And can you opt out if you want?
So auto-enrollment is a great thing, and the Commission is strongly promoting it. And I think we have a successful example now in Ireland, which is a country which started very late with pensions and sort of private and additional pensions. And they have a system of auto-enrollment. It basically means you are being signed up into a default product by your employer. The default product has a default investment cycle, which is tailored to your age and your sort of liquidity needs. And you can opt out, but the beauty of the auto-enrollment is that people rarely do so. And the other beauty of auto-enrollment, if it's optimally structured, is that as your salary increases, which hopefully is the case as you get older and more senior, there is actually also a progressive increase in your contribution rates. And again, that is auto-enrollment. So automatically, as you are more wealthy, you also increase your contribution rate to the pension, and therefore you increase the accumulation effect of your pension pot. So we are like fully in favor of auto-enrollment. It's a great thing. It's just that this has to be decided by each country in the European Union. This is not something where we have a direct treaty competence.
Understood. Two follow-ups. The first is you mentioned liquidity profiles. Could you explain that a little bit more?
So a lot of money can be made if you invest in so-called illiquid assets, which is assets which are private, unlisted companies. They have a premium over listed companies.
But a higher risk.
A much higher risk. And risk always is remunerated. That's how it works in finance. So if you take a high risk, you get a high return. If you take a medium risk, you get a medium return. If you take a low risk, you get a relatively low return. So the high risk is the private markets. Then the medium risk, I would call the listed equity. All the index trackers, the S&P 500, the Stock 600. You take the equity risk, but it's well diversified, so I would call that an intermediate risk, but you still get a pretty decent return, especially recently if you were in tech. And then you have the low return, low risk category, which is debt, which is bonds and fixed income and government debt. So there's almost no risk in government debt, but there's also very low return. So as you are young, you can take a higher risk because even if the stock market crashes, you have a lot of time to recover. And historically, the stock market has always had outperformed the bond market over the long term. That's why young people should take more risk. If you're in the middle category, you take intermediate levels of risk. And if you're shortly before retirement, you take lower risk. But lower risk does not mean that you completely get out of equity. All good pension plans still have up to 40% in equity, even post-retirement, as you draw down. Because still, drawdown periods are very long. People are living much longer in retirement. So even the retirement phase is decades. So you may remain invested in equity, and you still get the higher return even after retirement.
So, and then the second follow-up, which kind of follows up on this one as well, is so these aren't products that the EU has created. These are just products that are on the market, right? Where people that are involved, the person saving for their pension, they're the ones who choose their level of risk, and they are the ones who choose how much to put in, correct? Or did I misunderstand that?
Well, in auto-enrollment, it's basically the employer who chooses a standard default product with an intermediate level of risk, but with a life cycle. So higher risk when you're young, when you're in your 20s, 30s, intermediate risk when you're in your 40s to 60s, and 60 onwards, somewhat lower risk, but not totally out of equity. That's the default. If you want to take more risk, you can then opt up. If you want to take less risk.
The person opts up, not the employer.
Yes.
Got it. Understood. Okay. Now, talking about products, the Pan-European Personal Pension Product, also known as the PEP, which is a happy acronym. It's not a new idea. It launched a few years ago, and let's be honest, it didn't really take off. So why is the European Commission proposing a review now? What went wrong the first time, and what makes us think that it's going to work this time?
Private pensions, I think, are most of the solution to the supplementary pension debate. And in a lot of countries, let's take the US, 401k pensions are essentially the model for the PEP. The 401k pension is a simple default product, which the integrated life cycle, slow and gradual de-risking as you get older. Employer makes contributions, and the state gives you tax relief. So you are contributing before tax. That's the magic formula. And that is what the PEP, the previous version, has been missing. Tax relief was sketchy. Sometimes it was there, sometimes it wasn't there. The product was over-engineered. There were too many guarantees and safety buffers which basically eat your return. So if you want to have a guarantee, you're going to invest in bonds because that's the only way you can guarantee the cash flow. So you're going to leave all the money that you get in the equity market on the table. The new PEP 2.0, is going to be a life cycle product. It's going to be per se suitable for, as a default, for anybody. Is now probably getting all the tax benefits that they can because the member states actually committed to that. And that's why this time around, there is a higher chance that it will actually have scale and that it will have take-up because the magic ingredients are tax relief and online distribution, no investment advice, per se suitable, so nobody has to explain the product to you. The product is intuitively understandable with the life cycle, and it's the default, and the employer optimally makes a contribution.
Understood. Now, sort of we might cut this out because it might be a question completely unrelated, but does this in any way affect the effectiveness or the scale of the upcoming Savings and Investments Union?
It's one piece of the Savings and Investment Union because the PEP, to use that acronym, is basically nothing else than a savings product where you would be well advised to not redeem early. Now, the PEP, the wonderful thing about the PEP is that technically it is liquid enough that you can redeem early. So we're not, because of the life cycle I described, we're not forcing people to hold it until retirement. We're not forcing people to illiquid asset classes in a later stage of the life cycle so that they cannot redeem. But of course, the maximum accumulation is achieved if you don't redeem. But people, this is behavioral science a bit, people don't commit to a long-term product if they know that they can't get out. People commit to a long-term product if you give them the psychological reassurance that if something bad happens to me, then I can actually in extremis get out. And that is the wonderful thing about the PEP's construction. It is designed as long-term, but it's liquid enough that a certain percentage of people could redeem early without this product having to be gated.
Mm-hmm. So, well, that's good because that keeps the freedom with the citizens where they're getting a good product, but they're also retaining the freedom to step out of it at some point if they want to, if they really feel that they need to.
Yes, especially since they were auto-enrolled. Mm-hmm. They chose the default, but they will still have the certainty that if something bad happens in life, I can still get out of this product. And this is the difference between what we call a private equity investing, a private debt investing. That's a high return, as we discussed earlier, because it's a high risk. But there is, on top of that, the illiquidity. You cannot get out. The fund is gated. If there is no way that this can be turned into cash, the fund manager will tell you can't get out. And that can't happen with the PEP, because the PEP has this life cycle and this asset mix where it goes from illiquid up to very liquid and to fixed income. So there is always going to be a chance to make some of the PEP investments, turn it into cash and pay out a certain amount of people. Hopefully not all, because the product essentially makes no sense if you redeem early, because you are missing out on the accrual of all the sort of income over a longer period. But technically you could get out.
Okay. Provocative question. This is where I put my hat on as a hard-hitting journalist, which I'm not. Was there ever any consideration of limiting the possibility of putting in Europeans' hard-earned money only into the European markets? What I'm saying is that we have a problem with an awful lot of European savings that are being invested going overseas, going across the Atlantic to the Americans, which helps their economy, but does it help ours?
That is a historically correct assumption, but the design of the PEP would allow it to be also very much engaged in European markets, provided, of course, that the European markets produce a competitive return. That is part of the other package which the European Commission has, the market infrastructure package, because we have seen some sort of a budding activity in Europe. We have seen that some of the indices in Europe actually outperform the S&P 500. So if Europe offers a good return, there is a very, very good chance that the PEP is then also heavily invested in Europe. It's all a question of how attractive we can structure our capital markets to be, how much listings we can attract, and also because the PEP allows a certain amount of private assets, how many private assets in Europe are attractive enough to make the cut and make it into a PEP portfolio.
Okay. Well, it sounds like a good product, and it sounds like this is something that a lot of people are going to be interested in. So my final question is one that I always ask, and the answer is almost always, it's complicated. When is this all actually going to happen? When can people expect to feel the difference?
I think the PEP is a super easy product. The structure of a target date fund or a life cycle product is well tried and tested. There's no sort of reinvention of the wheel here. What we are providing with the PEP is a tax-efficient wrapper in which you can then buy these life cycle funds. And that's the innovative part. So you can get the tax benefit, you can get the employer contributions, you can make it as part of a default in an auto-enrolment system if you choose so at member state level. So this is a super easy product. We just need to have an agreement in Council and Parliament. Hopefully by the end of this year. We are steering to an agreement in the Council at the end of the current presidency, so it's end of June, and then hopefully negotiating with the Parliament until the end of the year. This wonderful product is so easy, so intuitive, execution only, that you don't need a lot of secondary legislation, what we call the level 2, all the technical specs, because this product is so easy, it doesn't actually need any of these technical specs. So in theory, anybody can offer this product as of whenever it's adopted, the rules about the wrapper, let's say 2027. So as of somewhere in 2027, maybe early spring even, anybody can offer this product in the market, and it's then up to the citizens to decide whether they want to take that opportunity.
Well, that sounds great. So it depends on Council and Parliament to come to an agreement, it gets adopted, and then pretty soon there's a new product on the market. That sounds great. Tilman, thank you so much for coming onto the pod to talk with me. I learned an awful lot. I really appreciate you being here.
Thanks, Aidas, and thanks again for having me on your podcast.
Okay, here's my take on this. For a long time, supplementary pensions have been something of a lottery in Europe. Depending on where you live or where you work, you either have access to a decent occupational pension scheme or you're largely on your own. This EU pensions package is a serious attempt to fix that. More people automatically enrolled, better run pension funds, and a personal European pensions product that people might actually want to use. That's a big deal. And the second thing, and I think this one often gets lost, is that better supplementary pensions aren't just good for savers. Pension funds investing for the long term are exactly the kind of patient capital that European companies and infrastructure projects need. So, this is good for retirement incomes and good for growing the EU economy. The proposal is now with the European Parliament and the Council, so watch this space. There's more information in the show notes. Do please subscribe, leave a review, and share this with that friend who's been putting off thinking about their pension. You know who they are.